agree or disagree that the 10-year yield is headed to 5.5%?
Well, I think like it's hard to predict rates. I mean, anybody that tries is gonna have a hard time doing that. But the important point is that structurally fixed income and yields have been, skyrocketed since the Fed started raising rates. And we know that they're going to be higher for longer. And what does this mean for investors, and how should investors be thinking about this right now? If you're concerned and you want to dampen different types of risk in your portfolio, we've been talking and advocating all through 2023 is you really, really need to be switching more of your portfolio into fixed income and getting better exposure and taking advantage of these yields, because there is a silver lining to this, and that is that yields are at historic highs. And there's really it's an interesting barbell. You can wait it out and get paid down in cash, as Jim was mentioning, in the short-term treasury market with low duration and low interest rate risk. But we're actually advocating that people move further out in the credit spectrum, reduce your duration, and get some credit exposure, because right now you're being paid for that additional risk in a way that you haven't been, and it's really important to do that.
All right, so Joanna's saying she's not going to try to forecast where the 10-year yield's headed, but do you agree with the principle behind what Bianco Research was saying there?
Over the longer-term time frame, it seems like we're going to be heading that way. But given the speed of this move and how quickly we've come, I think yesterday's reversal was very telling. And I think that rates should calm down for the foreseeable future, meaning into the end of this year. So as far as rates go, they've been driving this bus. I think they've come a little too far ahead of over their skis. And I think we're going to get a little bit of a cool-off over the short term, which will be good for equities. All
right, so obviously bond yields are really the story of the market yesterday. I want to talk to both of you about some tweets that we have from some very notable investors. I'm going to start with one from Bill Gross. He says, in part, on bonds, invest in the curve, various combinations, 210, 25, should go positive before year-end. I'm buying SOFR futures, higher for longer is yesterday's mantra. And then we have one from Bill Ackman. I want to bounce both of these off of you. Bill Ackman said, we covered our bonds short. There is too much risk in the world to remain short bonds at current long-term rates. The economy is slowing faster than recent data suggests. Jay, I'm going to start with you. What's your take on these two tweets from very notable investors really focused on the rise in yields and how to play it?
Yeah, no, that was the talk of the floor yesterday. It definitely moved markets. I think they're onto something. The higher for longer narrative, I don't think that is something that's going to go away anytime soon. But I think with the bond market, we may have put in a near-term bottom, and we may get a little bit of a rally here. So for me, those tweets were spot on. And, when those two guys speak, you always listen.
Kind of an E.F. Hutton type of effect
without a doubt.
Previous generation. Joanna, I'm going to come to you. I think you were basically saying something very similar to what Bill Gross is saying, but just want to make sure, agree, invest in the curve, various combinations, 210, 25. Agree with that way to play it?
Exactly. I think if you look at 2023, actually the curve itself has been more volatile than other areas of fixed income. And so, investing in the curve, either on the long side, the volatility of long treasuries has been almost as close at this point to the volatility of equities. So what we're advocating is get out of any kind of duration risk in your portfolio, look for a good quality credit. We really, really, really like the CCC category. It's yielding over 14%. It has lower volatility than the S&P 500. So if you're expecting some weakness in the economy, or you're thinking that rates are going to reverse, it just matters about how fast they're going to reverse. And coming down from levels like 14%, even in CCC and high yield, we really think that people should be considering these spaces. We think it's the best kept secret in fixed income. Very, very low interest rate risk across the board. But the reversal of rates is probably going to take some time. And for 2024, you still need to be thinking about these fixed income areas.
All right, so Joanna's focused on that best kept secret. Jay, do you have a best kept secret for us? Our audience, they're always looking for great ways to invest when it comes to equities and bonds.
Yeah, well, I think the secrets are going to be revealed this week. Jim Cramer tweeted, you were talking about Twitter. He tweeted this morning, this is the playoffs for the market. And this earnings season is going to be telling. When you have Microsoft with Katie Stockton, I actually did a great preview of yesterday on your show, and Google today, these stocks are what's going to move the equity market right now. 14% of the S&P 500 is consistent of Google, Microsoft, Amazon, and Meta, which report this week. So this, to me, is the tell. I think earnings are there. And then watch the Russell. The Russell has been been beaten down because rates have spiked so high. They're coming into a nice floor, and over the long term, if you back it out, you look at a chart at the Russell, we're at a major support area. So I think we're going to get a little bit of a relief rally here, and the mega caps will kick it off.